are officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. We're not struggling to get just 4 or 5 people on a webinar. We got the full community in the house. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to affectionately call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
Welcome back, Gregg, from your golf trip. And with us today also is our community manager handling everything that you need, Madison the Magnificent. Welcome back to the show, Madison.
Hello, everybody.
Good to have you in the house. Good to be back. Good to have GC on the other side of the microphone here with me, as is our natural state here after what was an awesome show last Thursday where we got to meet the rest of the team. But what really pumps me up is having the community in the house. And that's why we tell you, if you're watching on YouTube, if you're listening on the podcast, go to one of these days. Just pop in nyais.com, throw it on your calendar, show up, and be a part of this little tradition that we call what, GC?
The roll call.
The roll call. We ready. Madison already kicking it off. Welcome to the Not Your Average Investor Show. We got our leadoff hitter of the Not Your Average Investor Show, the John Henning. We got Tony D in the house. Anthony Ditto from Jupiter saying greetings, friends. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill, saying good afternoon, everybody. We got B-Town Shelly Johnson. Hello, all from Bradenton. Welcome back, Shelly. We got Nadeem Shah with his characteristic hello, JWB family. Good morning, good afternoon from the West Coast. We got Bill Shields challenging my international acumen with his bon pomeriggio, signori e signori. Bon pomeriggio to you, Bill Shields. Who else we got? We got the guy everybody knows. Noah Randari saying hello, everyone. Greetings from California. We got Denny Davis checking in from Germany with Guten Tag, Denny. We got the patriarch and matriarch of the first family of the Not Your Average Investor Show, Ken and Carolyn Moline. We salute you.
We salute.
Yeah, you got it. You got it, buddy. We got Mark McDermott. He's back. Welcome back, Mark. We got Gene Ferreter back as well. Good to have you. We got Eddie Harris from Hot Atlanta. Welcome back, Eddie. Who else we got checking in here? Sean Hanna. Welcome back from Hampton, VA. Sean, good to have you back as well. GC, you know what I love about today's show? You know what I love about the things that we've done is that these Not Your Average Investor segments, insights, not your average market insights, that we have created this system to have a topical show is not just a fan favorite content pillar, but it also saves us when a guest has to reschedule at the last minute. So yes, we were going to have Nate Dotson to talk about crowdsourcing, crowd sharing, as far as rental property investings. He pulled an audible on us. We did it. He's coming back in like 3 weeks. It's going to be an awesome show, but we are hot and ready to talk about some really pressing stuff that's happening out in the marketplace, because this is our new favorite thing that we like to call Not Your Average Market Insights. GC, you ready?
I'm ready, brother.
Anything you want to share with us right now from your golf trip, from what's going on with you, anything you need to update the community on right now?
You know, my golf game is in a sad state right now. I played 2 of the best golf courses in the country, and they let me know that I am not of that caliber. I played Whistling Straits. For any golfers out there, I played Whistling Straits, which hosted the Ryder Cup, and then I played Erin Hills, which hosted the U.S. Open. Did that in a few short days, and I had a blast. It was amazing, but my confidence in my golf game right now is probably at an all-time low.
You know, Denny Davis, I'm sure, knows this. There's this expression in German called Schadenfreude, which is the taking pleasure in others people's misfortune. I want you to know I experienced none of that for you. I wish that you would have played better. I'm just glad you're back, buddy.
And I don't know if I believe that.
I hope that you do. It's genuine. I only bring it up because it's a thing, not my thing. That's all I'm saying. GC, Gerard wants to know if you broke 100. I would hope you broke 100.
I did break 100 at Whistling Straits. I shot 99. I had to hit like a 4-foot putt to break 100. I shot 95 at Erin Hills, and it wasn't pretty. Yeah. But moving on. No more talk of the golf game because that has been bothering me ever since.
Well, let's talk about something else that's been bothering you, buddy.
Yeah.
How about that? We are, one of the things that we've been talking about lately on the show is this idea that national headlines are national headlines, right? Like they pertain to, they have flaws, right? Like number one, when you cast a very, very wide net, you're not speaking very specifically into a market or a specific dynamic. It's not something that investors, while they can keep their ear to the grindstone, national headlines aren't generally going to move the needle for you. But even worse, we're living in a world where the media system is incentivized by clicks, right? So kind of like when we went into the system of saying extra, hear all about this, and people were selling single papers, we're doing that, right? So there's this dynamic when you are a investor and you're trying to build a portfolio that is going to serve you in retirement. There is things that are not in your favor when it comes to guiding yourselves by national headlines. And you've identified a couple of these, right? There has certainly been, and I think we can talk about two separate ones that you've sent me. The first one is this idea that spiking mortgage rates have already pushed the housing market into a housing correction that was published by Fortune magazine, saying that we're in a full-blown housing correction and we'll soon see year-over-year rate of home price appreciation fall from a record 20.6% to 0%. And what do you think of that? What's the problem with that headline, GC?
Well, I think the problem is that there's not a standard for when we use certain terms, first of all, but we tend to the national headlines tend to throw them around like they are a standard across all asset classes. And if you start to use the same terminology around all asset classes, you paint a very different picture than what reality is. And so there's just they use many terms very loosely. Even when they do pay attention to actual data, they use those terms very loosely. Like the first thing for me, when you just heard housing correction there, Pablo, what does that make you think?
It makes me think of a stock market correction, right? Like that's where that language comes from for me.
Yeah, exactly. So a stock market correction is known to be a drop between maybe 10% from the high up to 20%. Or I guess down to 20% from a recent high. That's what we would call a stock market correction. So when you hear a headline that says there's a housing market correction, Pablo, what type of drop are you expecting?
I'm assuming a 10 to 15% kind of like haircut on the value of the property that I own.
Yeah. You want to know something interesting? I don't know if I've ever shared this on the show, but it just struck me. Do you know, even during the Great Recession, we never had a housing drop of 10% year over year in Jacksonville.
Interesting. What was the total market drop during the Great Recession?
It was about 35% in Jacksonville over a 3-4 year span.
And it was never more than 10%?
Never more than 10%. We never technically had a housing correction, if you use the same terminology across all these different asset classes, in the Great Recession. So, and then if you actually read that article that I shared with you, which was from a national public, it was from, did we mention, I think it was from Fortune, right?
Fortune, yeah. It was Moody's Analytics on Fortune.
Yeah. And so they quoted, these are very respected publications, right? So then you actually read that article a little bit more, and it quotes the chief economist of Moody's, and who had said, hey, we're here for a full-blown housing correction. If we are standardizing what correction means, right, you would expect 10 to 20%. What do you think a full-blown housing correction is? That's probably closer to 20% loss, right? So there's these terms are used very loosely, thrown around, and they create a lot of hysteria. And you're right, they generate a lot of clicks. It's not very sensational. It doesn't drive a lot of revenue for you or me or anybody else to get on a platform and say, you know what, I think that housing is going to cool, and I think it's going to level it out, and I think we're going to get back to basics, and I think people are still going to invest the same way they always should have been investing in rental properties. Like, that's not going to drive any clicks. Reading that article a little bit more, though, what I did think was really, really interesting, and a miss on the chief economist who was quoted here, in the exact same sense where he says we're going to see a full-blown correction. He goes on to say we are going to see home prices, in his estimation, flatten out to 0% growth over the next year. How full-blown housing correction, in the same sense, he defines that as 0% growth, right? Very different. And I don't have too many examples in the same sense where it's like speaking out of both sides of your mouth like I do on that one. But for that one, you can clearly see that there are the people who are writing the headlines for the articles are very different from the folks that are actually creating the data or providing the data. And even those folks sometimes are talking out of both sides of their mouth.
Yeah. So I'm gonna think like a marketer, and I'm also gonna think like a devil's advocate here, right? As a marketer, I understand that words carry meaning, and people move close. They move quicker away from pain than they do towards pleasure. And throwing a word like correction that is so loaded in people's heads will incentivize, a click. It will incentivize a conversation. It's working because we're talking about it right now. So
Sure.
Fortune is getting, so as marketers, they're doing their job and they're incentivized the way that they're supposed to incentivize. I guess I think that the overall conversation of how do we standardize language across investment types so that this doesn't happen, I think is a really fair one, right? Like we've talked about this a lot. We've tried with the investing scorecard. We've tried to on this show. I think it's one of the missions of the show is like normalize language and expectations and feelings across the different things that happen in asset classes so that you can build the best rate adjusted, risk adjusted ROI into your portfolio based on your standard language. So I give what you're saying there a ton of merit because I know the psychological dynamics working. If I were to go devil's advocate, if what this dude believes is going to happen nationally is going to happen, and play with me here on this one, but if it's going to go from like if we are nationally growing at 20% to zero, it is a delta of minus 20%, which does go with kind of like correction language. What do you think of that?
Would you, if the stock market was up 20% earlier in the year, and then you expected the stock market over the next year to be flat, would you say that that's a stock market correction?
No.
Why do we say that about housing?
Yeah. Okay.
I think there's a double standard out there. And it just, it plays into the fears too. I mean, listen, a lot of us are, especially in our community here, we're affected by the Great Recession, either with our primary residences or rental properties or other real estate that we had. I mean, we still have a very sore spot for what real estate caused in terms of a recession that was unprecedented. And so, we have now since then seen real estate go up at higher than normal rates for a long time. And there's a reason for that because we crashed so hard during the Great Recession that they are going to go up. But there's this, we kind of feel it. Like if you just let emotions guide you here, you should say, oh, geez, it's been 10 plus years of real estate doing really well. All right, we got to have a correction. We got to have a crash. We just have to. But when you look at actual data, when you look at supply and demand, it tells you a very different story. And the risk here is if you go on emotions and you go on the headlines and you go on what the talking heads are saying because they're incentivized to give you the most sensational story, you're going to make bad decisions with your money. And so that is a mission of the show, is to get rid of this double standard when it comes to other asset classes. And I think a big part of that is the language that we use across other asset classes. So I think we're going to have a lot of examples as we go forward for the next, call it, 3 to 6 months. We're going to get a lot of examples. Everybody on the show should be very, very prepared to see a lot of very negative headlines on the real estate market is going to happen. There's going to be some truths in those. When we talk about the number of home sales going down, I fully expect that. When we talk about the number of inventory, the amount of houses on the market going up, I fully expect that. But what we have to keep in perspective is that the place that we were at was unprecedented as far as the ratio of sales and inventory. It was so low for that months of inventory number. We have never, ever seen it like that. We were under 1 month of inventory. And so for those who watch the show, or maybe this is your first time, a normal equilibrium market is between 6 to 7 months of inventory. The reason we say that is because if you look over time, when you have 6 to 7 months of inventory, you normally see normal home price appreciation in your market, which in Jacksonville is 4.6% appreciation each year. So that's saying that we would need to have 6 to 7 times the amount of inventory per sales in Jacksonville just to get to normal. So as it starts to creep up, right, we are still way below the normal equilibrium of what a market should be. And that is the perspective that we need to have as we go into this time where sales are going to normalize. Inventory levels are going to normalize. And it's a good thing. It's a good thing for the market. It really is.
So if I'm hearing you correctly, GC, and I want to kind of touch this one first I want to touch the idea of we're all still affected by the Great Recession. And that I want to just talk about the fact that next week is the investor only call, right? Like the client only call, which then we talk about on the show. And you're going to talk about what is it called again?
The recession myth. The recession myth. The myth that is out there that real estate values go down during recessions. We're gonna explore that one.
Okay, cool. So that is a myth. I've heard Alex talk about that 2 years ago. I'm very interested on your take on it, updated for today. But what I'm hearing in your language is it may help us to think of this as a housing market normalization as opposed to a correction. And that can, if I think through that, as opposed to just kicking it back to you, I think of the idea of correction being this like negative, punishing thing, while a normalization means, oh, okay, then that means I can just keep operating according to the rules that have always been set, and I'm going to be fine, as opposed to I need to change all the rules.
Yeah, exactly. Normalization is a much more accurate depiction of what has to happen, what I truly want to happen. I don't want values to keep going up 20%. Because that has negative ramifications all over the board, right? I own a lot of real estate here, and there's a lot of clients that are on the call here, right? Like we all should be very, very happy with a normalized market, right? A normal market in Jacksonville goes up about 4.6% each year. I want to bring up one more point, and I haven't really shared this, but I want to get ahead of some of these negative headlines that you guys are going to see, because I think it's going to get rough. And I want you to be prepared to know what the data actually shows. And because we're going to talk a lot about, right now, we've been talking about home sales going down and inventories going up. If you actually read the headlines right now, you're not seeing price declines, right? But let me tell you that price declines are coming, okay? Price declines are coming. And here's why this is normal. This is still a normal market. There's a thing called seasonality in real estate, right? From the summertime to the wintertime, it's harder to go out and look at houses, right? You're less likely to go and move because your kids are in school in the winter times and they're not in the summer times. So home sales, even in a normal market, decline as you go into winter. And if you look over the long haul, home prices in the Jacksonville market go down about 12% from the summer to the winter. And this is a normal thing that happens every year on average. And you still see on average 4.6% home price appreciation. And that's going back over the last 40 something years on average. So this is an important point, right? The way that home price appreciation is typically calculated is year over year. So if it's the price in November last year, you look at the price in November this year, that number is still going to be up, okay? Because we've seen a lot of appreciation this year. But what I'm expecting a lot of less educated, headline-driven media articles are going to start saying is, oh, geez, prices declined month over month, right? Prices decline month over month from from the summertime to the wintertime in a normal year. That doesn't mean that this is going to be a crash. But Pablo, you can already see, if we're already calling this a full-blown housing correction and home values are still actually going up, you can just imagine how they're going to use that convenient data point of saying, well, geez, and pricing in October was higher than pricing in November. They're going to say, well, that's a sign that the market is crashing. Be prepared. Home values will go down as we go into the winter. That's very, very normal. The only time it hasn't happened is like the last 2 years when it's been really weird. And we've just had this incredible demand and lack of supply, largely driven by the pandemic and interest rates being so low. So be prepared. You're going to see headlines that are saying that housing prices are coming down. Check to see if they're talking about year over year. That's the accepted way to evaluate home price appreciation. If they're talking month over month, I fully expect that. That's normal. That doesn't mean that this is a correction. That doesn't mean that year over year home values are going to go down.
In the seasonality of home values going down for the retail purchaser of homes, the person that is moving their kid in the summer because it's easier to, switch in between school years versus right at the end of the first trimester, does that seasonality of residential home purchases affect the seasonality of investment home purchases?
Not typically. I mean, you got to think about what are the motivations for somebody who's selling their home and maybe moving into a new home, right? Are they carrying then, two payments, or do they need to wait to sell the first house in order to move to the second house? And they have a shorter timeline to be able to manage everything as far as their kids' schools and whatnot, right? That's a lot of pressure. And at the end of the day, it's because they don't have a way to cover their payment every single month while they go and find that next home. So for like JWB, we don't have seasonality of prices, right? Our prices don't go down 12% in the winter. They don't go up 12% in the summer, just keeping it, normalized, right? And the reason is because our assets pay for themselves every single month, right? So, our sales don't even go down in the winter typically, right? There's not this seasonality component. We're a very small microcosm of the entire macro sense. Then there's a lot of other motivations. And so if you're looking macro sense wise, and if you're looking to buy a house for you to live in, I would definitely say you could get a discount by buying in the winter versus then buying in the summer, but it doesn't work that way in the turnkey investment space. That's for JWB. And that's for some of our friends out there who are in the same space as us. You're just not going to see a lot of seasonality. It comes down to the fact that, listen, even in the worst case that our sales would decline, the assets pay for themselves every single month. So we'll just wait a little bit longer, collect the rent, collect the cash flow, and sell it when we sell it. So that's a great question, man. I'm sure that was on a lot of people's minds.
Yeah, that makes sense, man. Because I'm trying to decouple that, because immediately Sarah Jennings asks, is this the best time to invest in the winter months? And to me, that sounds like not if you were investing in a turnkey, passive investment home provider, right? Or a vertically integrated home provider. Maybe if you are an active investor and you are sourcing deals, then at that point, then you're trading a little bit of time for money. And maybe you find a deal of somebody that really needs to move because their kid is whatever, and you can find it. But if you are investing as a passive investor, it doesn't sound like it. But it does if you are looking for a home to live in and you're going to do the work yourself.
Yeah, I think if you're a retail owner occupant, you're looking for that next house to move in for your primary residence, I think that is a strategy for you to get a discount, right? Buy when other people are not buying as much, and you should be able to get a discount buying in the winter. In Jacksonville, it's been 12% on average over the years. So that's very real. In the investor side, either active or passive, I don't really see that being a strategy. On the active side, I don't see it being a strategy, because many times if you need to buy at the type of discounts to be a successful active investor, those opportunities are going to come at all hours of the day and all times of the year. It's largely going to be driven by whatever situation that was. Like, was there a foreclosure sale that you bought it from that foreclosure sale, right? Was there a distressed homeowner that needed to sell, right? You don't wait to try to find those opportunities at the end of the year to get the discount. You need to be pounding the payment at all hours of the day. So I don't think it applies for the active investor. And it definitely doesn't apply for a turnkey operator too, again, because they don't have an incentive to sell, right? Their properties should cash flow for themselves. If they're in their inventory, if they're good at renting them out, then there's not a motivation there.
Well, man, you definitely brought up a bullet point that we weren't planning on talking about, but I love it, man. That was a really cool context there. The next headline that I wanted to bring up as far as is this idea that the other headlines that are happening is home sales are plummeting and inventory levels are soaring. What do you think of that headline, GC?
Well, again, that is a lot of sensationalism with a lack of perspective, right? So let me try to give their argument. Okay. So in Jacksonville, our inventory levels were at the number of homes on the market. We're at about maybe 3,500 at our low, 3,500 homes on the market. Inventory levels now have gone up. I think they're about 5,500 homes on the market, maybe getting close to 6,000. And that's gone up probably over the last, 7 months or so, 6-7 months. And so these articles are coming out and saying, listen, inventory has doubled or gotten close to that. Inventory levels are spiking. They're incredibly high, and that's leading to this full-blown housing correction. So sure, if you want to play the percentages and you want to play the math game there, that would be factual, that inventory levels have risen, but it lacks the perspective. When we were at 3,500 homes on the market, we were selling close to 3,500 homes on the market every month. That is the biggest undersupply of housing in Jacksonville that we have ever seen. And it's that way almost in every market across the country. We were so low as far as inventory levels that they need to come up. They have to come up, right? To give it perspective, a normal housing market, again, is 6 to 7 months of inventory. So we're seeing, roughly about 2,500 sales a month in Jacksonville right now. So what's that times 6, right? That's 15,000 houses in the market. On the market would be 6 months of inventory if we're selling 2,500 a month. So when we're going from 3,500 active houses on the market 1 month to getting close to 6,000, sure, that's going up. But the fact is we're still almost 9,000 houses undersupplied if we're looking at a normal market being 6 months of inventory. And then give it more perspective. When I started to buy my portfolio in 2006 and 2007 and 2008, I still have that data. I know what the months of inventory were back in the day. I know what a market that looks like that really is going to have what we may call a housing correction, right? Getting close to 8% drops a year or something like that. In that market, we had over 16,000 houses on the market, and we only had 900 sales the previous month. That's 18 months of inventory. So I know what that looks like. This is not that. This is normalizing. This is getting closer to what we all really should want, which is real estate. You win slow and steady. You buy based on the fundamentals. The 5 profit centers pay you so well over time, and you get to work with a great team to make it a great experience for you. You get to sit back and let those 5 profit centers work for you, and you hold on for a full market cycle. Like, that's my mindset going into owning rental properties. I hope that's everybody's mindset here. And if you're of that mindset, consistency, beautiful thing, right? I'd rather have 4.6% every single year rather than 10% 1 year, 15% 1 year, and then 1% or 2% or 0% the next year. So I think we all need to have perspective. As I was sharing with you right now, our inventory levels have gone up. It's fully what we were expecting. Absolutely. I expect them to go up from here as well. But just keep in perspective that the great equalizer of all of this, and this is a metric we've been quoting even before the pandemic, it's this months of inventory number. That's going to be the best guide for what is going to happen with prices in the short run.
It makes a lot of sense, man. It's funny because I'm watching you out here on a limb. And it reminds me of, I'm glad you mentioned before the pandemic, right? Like this really does remind me of when we had the great opportunity to stand in front of our community in March 2020 and April 2020 and May 2020. And kind of this idea that you're out here saying a couple of things that are contrarian to national headlines, yet quoting the same statistics, right? This months of inventory. And Drew puts in, which I think now our community, if you come to the show, you're very familiar with, right? Drew is the ringmaster, putting in the chat, these headlines read 200% jump in housing inventory. But when you get into the article in small print, it reads inventory still 40% below pre-pandemic levels, right? So and we know what's happened since.
It's insane. I'll give you some real perspective. Months of inventory right now is 2.33 months of inventory in Jacksonville. I went back and I looked in June of 2020, before we just saw consecutive years of 15 to 25% home price appreciation. And months of inventory was 2.5 months at that time. It was actually higher back in the day before we just saw that incredible growth than it is right now. So that's not to say that I expect to see that incredible growth happen again, but that is the perspective that we need to have. We are rising for inventory levels. We are seeing home sales numbers normalize. We're seeing a decrease in the demand, largely because interest rates have just spiked at an incredible rate that we haven't seen. We haven't seen that in our country's history many times. And so you would expect that would dampen demand. It is. That's okay. We've got a long runway to go before we would see housing declines. And even in the Great Recession, we never saw a housing correction as defined by what a stock market correction would be. We never saw a 10% loss year over year.
Yeah. So Nadima's got a question since you're on it, right? Like how soon do you think a price decline will take place? And do you think that that prices will decline in Jacksonville?
I'm not convinced that they're going down. I'm still formulating my thoughts on this. I think one of the things that I could do that would not be helpful right now is just because, I'm looking at the data today, just coming out and shooting from the hips and saying, hey, listen, housing prices will never go down. I don't want to do it like that. I want to be with you guys as we go through this. There's a ton of variables here that change every single day. But as I see it right now, I don't see home values going down. The reason that I'm looking at that is largely based on months of inventory levels. And when I see inventory levels like they are, this market is performing exactly like we have been talking about that it would. As we started to normalize, you're going to see inventory levels go up. You're going to see home sales start to come down a little bit, or at least dampen. And you're going to see months of inventory levels start to rise. The big question for me is, how high do they rise and how quickly do they rise? Right? If I start to see months of inventory levels and quickly getting to 6, like if I saw a jump from 2.3 to 6 next month, I'm going to be right here with you guys. And we talk about that. We talk about, your investment decisions. How is this affected? We would talk through that. As if I started to see months of inventory levels start to get to 7, 8, 9, 10, 11, right? Then I'd be right here and I'd start to say, listen, guys, let's talk about a pricing decline, because I see that happening. But I don't see that. We're at 2.33 months of inventory. For the first 5, 6 years that we started tracking months of inventory number, we never got lower than like 3.5. Like, it is still so low. So I feel really confident saying that I don't see home values declining. As we see it here, that changes. We'll certainly talk about it. But I think the other point that I need to make sure everybody understands here is that, remember, Pablo, back in the day when home values were just off their rocker going up in the pandemic, and, and everybody's talking about these levels that are going up 10%, 15%, 20% a year. What was my message to everybody as far as the importance of short-term pricing?
Short-term pricing is like not something that you count on in a full market cycle.
It's the least most important part of it. I don't count on it, and it's the least most important part of your decision. I was saying that to all of you as home values were going up 10%, 15%, 20% a year, right? Like, why was I doing that? It's because I knew that there would be a time that home values would start to normalize. And I wanted to make sure that you make that same decision. That same decision-making criteria should be the same when you were buying 2 years ago as home values were going up as right now, which is short-term pricing is the least most important thing, right? You can only count on home price appreciation if you buy in for a full market cycle, which is known to be between 10 to 20 years. That hasn't changed. That shouldn't change for you. So keep that in mind. Short-term pricing is the least most important thing. And you guys have seen, especially fans of the show here, you've seen some of these case studies where I showed my own mistakes at buying at the quote unquote worst time, buying rental properties in 2006, 2007, before the housing market actually went down about 35%, right? You saw all of that.
Yep.
Well, the reality is those properties performed really, really well. Even though housing prices declined about 35% in the first 3-4 years that I owned them, those properties have earned, there was 17% return on my money every single year that I've owned them for 16, 17 years now.
Yep.
And that should reinforce to you that this concept of buying and holding is the way you win. You buy and hold, you find a great team to support you all the way along the way. And those 5 profit centers pay you. And then home prices tend to repeat themselves over a 10 to 20 year cycle. That's going to happen from this moment for the next 20 years, just like it happened for the last 20 years from this moment.
Yeah, it's funny, man. As you're talking about all this, I'm just like, I get what you're saying, but it comes down to kind of the way that you and I both, I think, make decisions. Even in our working relationship, you've always been a quantitative data guy, while I've always been a qualitative data guy. Like, I'm always saying, why don't we talk to people? Why don't we, blah, 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 right? Like, you're like, no, what does the number say? And to me, I think of the qualitative data as, I know so many people that are dying to get out of Miami because it's too expensive and putting money in Jacksonville. I know so many people that are dying to get out of New York because it's too crazy to live there and putting money in Jacksonville. So even in this whole macro economy thing, of home prices going down or flat or we're normalizing if that's what we're talking about. The idea of pricing in Jacksonville ever being any cheaper than it is going to be right now to own real estate in a city that has every tailwind going in its favor in a rapid rate of change, while still being the best deal within the state, the best deal on the Eastern Seaboard, as far as a well-balanced economy, quality of life, cost of living perspective, and climate. I find it so hard to think that prices are gonna go down, right? To me, the normalization makes some sense with interest rates or whatever, but people still need to, all that stuff is happening in all these other markets that are just way more heated and are not middle of nowhere Alabama.
Yeah.
So,
if you are still concerned about a housing crash or correction, even though the data is showing you that we are not there, and I don't expect us to be there, but if you still are concerned about that, then another way to hedge your bets would be to invest in areas that have significant population growth. Population growth hedges your bets against pricing declines because there's significant demand from people moving there that need housing. So if you want to go to every length to potentially protect yourself against a housing decline, which I just shared, is the least most important thing if you're buying and holding rental properties. It's the least most important decision. Your direction going towards a market like Jacksonville is still strong, right? Because we are a leader in population growth. We had the 5th fastest growing population from 2017 to 2019, according to the US Census. That was before the pandemic. And you look on all of the charts since then, and Jacksonville's definitely in the top 5, top 10, many times in the top 1 or 2 of places that people are moving to. So we would expect that number to continue to grow. So sure, if you want to hedge your bets against that, then go to the highest population growth areas. But like I said, it's not pricing declines are not something I'm concerned about. We are continuing to buy as much as we possibly can. I'm continuing to advise clients to buy as much as they possibly can right now for 2 reasons. Number one, I don't think housing prices are ever going to be lower than what they are right now, like you pointed out, Pablo. And number 2, what else are you going to do with your money right now?
Yeah, we haven't even scratched that.
Yeah. What are your other options right now? None of those look good to me. So Jacksonville rental properties, as long as you just buy into this slow and steady approach, slow and steady, that's what we all need to do. Right.
Reminds me of our first one of our first shows when I asked each of the partners what their superpower was, and you called Alex this super cool predictor, and he called you a turtle.
Yeah, that's right. How about that? The turtle's gonna win now.
Turtle's gonna win.
My turtle game is strong.
Yeah, boy, the turtle is back. Gerard Wendling says ninja tip of the week when Drew puts in here, and income growth, which was 12% in Jax last year, right? Not just population growth, income growth, which is huge.
Love it.
Awesome, man. So Darren Seaman's got a great question here regarding MOI. How do the builders and the price to build a home come into play in the MOI calculation, the months of inventory calculation, and home prices with falling prices in lumber, et cetera, i.e., can they impact the overall market?
Cool. Great question. All right, keep that one up there, Pablo, because I just want to make sure I'm reading it. So how do the builders and the price to build a home come into play in the months of inventory calculation? Well, that is a big part of this MOI calculation. I mean, the thing we've been talking about all along is that there's so much building going on right now, and it's very hard to get insight into how this amount of inventory is going to affect the months of inventory number. It's something that we're trying really hard to get insight into, because that could affect the outlook on short-term pricing. It's part of the reason why it's so hard to get this number is a lot of the building that's going on is actually build to rent communities. So a lot of this building is actually not going to supply homes for sale. And so this months of inventory number that I'm sharing with you is based on the number of available listings that are for sale. So this is unprecedented, the amount of building that we're having right now and the type of building, whether it's going to be for sale inventory or for rent data or for rent inventory. So it's kind of a long answer there, but it is going to affect it. What we would expect to some degree is that home builders are going to increase the inventory levels, right? They build communities of 100, 200, 300 homes, right? those inventories are going to come online. That's why you're going to see inventory numbers rise. And, but we just don't know how much that's going to impact it. And then falling prices in lumber, we have seen lumber prices fall, but we're seeing a lot of increases everywhere else. I was just looking at this, looking at our builders, I see those numbers. And while it's kind of like, it's kind of like whack-a-mole right now. You see one, input cost go down and the other one spikes, right? It's electrical or plumbing or whatever, right? So we do not see our overall build costs going down, although lately we've seen lumber costs, or at least the futures of lumber pricing, come down. We've started to see some relief in lumber, but nothing's changed. It's still way more expensive, and we're hoping that it comes down, but I'm not putting a timeline on when overall build costs are going to come down.
All right, that makes a lot of sense, man. Drew puts in here that he happens to work for a product group at a company that's completely remote, and I'm seeing team members moving to Florida in droves. And that makes me think of like the Zoom town thing, right? Like now all these towns have this like unprecedented growth because you can work from Zoom. And it makes me think of like this idea that there's tons of Zoom towns in Florida. I would say Jacksonville is the only Zoom city. Right? Like it's a complete city, right? It's not, this isn't moving to Claremont. Like I have a friend who's an email marketing genius. She just moved to Claremont, Florida. Like punch me in the face, right? Like I rather, I don't know. Anyways, we can go.
Well, we know we're not getting any more listeners from Claremont, Florida. I got that.
Man, listen, yeah, correct. Yeah, I'm not moving there. So, all right, man. So let's move into, I think that this was great, right? Like I'm taking from you this idea that language is being used in an unfair way for real estate. The data does not support what this language means. Jacksonville, real estate in general is not performing as bad as they're saying on a national level based on what they're saying and what they intend it to mean. And then locally, on a local level, we've learned to look at real estate not just as a national number, but as a localized number. So like if we are going to now look at it as not an average investor, but not an average investor, and we're going to be educated about it, then we're looking at local market dynamics to figure out what we're doing. What's happening in Jacksonville is different than everybody else because of the growth of population, the growth of income levels, and all these other tailwinds that are happening. And it's unfair to look at kind of our investments in bubbles as opposed to looking at it as like, if you have money, you're going to have to, you're going to have to figure out a way to continue to build wealth right now. So what else are you going to do? Hence, national headlines are inflated and not serving us.
Yeah. I mean,
kind of the overall,
yeah. Data without perspective is dangerous. We're getting a lot.
That's a quote card. Data without perspective is dangerous.
Yeah. I like that. Prepare yourself. You're going to get a lot of that from the media.
Cool. Like that. So let's dive into a little bit of more data, right? Like one of the other things that we said we're going to talk about here is this idea of how rents perform in bear markets. And Ken Moline, patriarch of the Not Your Average Investor Show First Family, puts in the Q&A, does a correction in housing prices, he puts quotes there, in Jacksonville have a mirror on the effect of rental rates for these homes? What do you think of that, GC?
I'd leave it to the patriarch to give just the perfect segue into the next segment of the show. A lot of questions have come up about rent rates in a crash or in a recession. People are trying to think of a worst case scenario out there. And luckily, I lived the worst case scenario when I bought those 40 rental properties in the first few years. Just to bring everybody up to speed, those were in the years 2006, 2007, and 2008, before home values dropped about 35%. And folks often ask me, well, did rents drop as well? And people are surprised when I tell them no, rents did not drop in Jacksonville during those years, right? Rents didn't drop in my portfolio. And for the longest time, I just shared that information just because I know how it worked for us, right? Though I had that data, but I didn't have other actual data to back it up. But we're really good friends with the team over at John Burns Real Estate Consulting. They provide a lot of the data that I get to share with you all. And so I was going through the data through John Burns, and it was really cool. And I can share this with you guys in a minute here. But you're able to see year over year over year, what have rent prices grown at, or what have rent prices potentially declined at. And it actually goes back to the great the Great Recession. So I'll share that information. You want me to pop that? You got that, Pablo?
Too late, buddy. Already got it.
Gosh, you're the man. You're the man.
Stop it. So what does this chart tell me, GC? So I see like a rising and lowering graph, but that I think that what I'm reading here is the increase of rent that is happening. Is that what I'm reading?
Yeah, exactly. And you can see that historical average since 1985, just for the Jacksonville market here, is 3.3% per year. That's saying that on average, since 1985, rents in Jacksonville have risen 3.3% per year. That's why we have that on our deal evaluations. When all of you invest in JWB properties, you see rent growth numbers at 3.3%. Well, this is where we go. It's all data driven, right? Now, as you go back over the years, you see in 2005, we were at 4%. And, as it started to go up, right, 6% as the market got inflated. The rents came down from where they were when they were 6% going up every single year. But look at that. They basically were flat. They dipped slightly below. I don't even know if that's like negative 0.2% or something like that, maybe in 2010, and then rebounded again in 2011. And so if you look over the entire Great Recession, right, we're talking rents now. Rent values actually went up even during the Great Recession, which is exactly what I experienced with my 40 rental properties here in Jacksonville.
Right. So again, to clarification, this is increase in rents, right? So this here, when between 6 and 0, means that the rent was going up between plus 0 to 6, and then dips into maybe going down 0.5% for less than a year, and then going up again from all the way up to where we are right now, which is super high, right? It's in the 10+%. Mm-hmm. And he is still predicting that through, I don't imagine that many of us believe that we're going to be in a bear market for more than 2 years. It generally doesn't happen. So through this idea of beyond 2024, Burns, who is, the foremost expert in this stuff, still has rents rising above, right above the usual medium of 3.3%, maybe slightly below going into 2024, but still going up, right? Like not anywhere close to 0.
Absolutely. And, for all of the sensational headlines that we're reading about and all the talking heads saying that home prices are going to decline and there's going to be a correction, a full-blown correction, all of that, for all of those talking heads out there, I haven't seen anybody saying that rents are going down. So that just should share with you how that you can't even find a bit of information out there that would lead people to believe that rents are going down. And the big reason is because as homes become less affordable, as home prices continue to go up, and we've seen as interest rates go up that it makes home purchases less affordable, people still need a place to live. So that increases rental demand. So you can write this down. I am very confident that I don't see rents going down at all. Right. And I think they're going to go up, largely at, the levels that we've seen on average over the last 40 years or so.
I think we'd be remiss not doing our community, if anybody is new here, the reason why this idea that rents aren't going to go down is because when we talk about the 5 profit centers of rental property investing, home price appreciation in the long term is the biggest bucket that you're going to gain from, as long as you are breaking even or slightly positive on the cash flow side of it, right? So this idea that rents are not going to go down from when you purchase this asset, right? Your cash flow is not going to get worse in the long term when you're, for an extended period of time, when you're purchasing that asset, locks in the risk of, not being able to afford this asset in order to really take advantage of the long-term buy and hold mentality piece. I feel like that deserves some clarification as to why we're talking about rents, right?
Exactly. Just as strong as I go saying short-term home prices are the least important part of this decision to buy rental properties, that is not what I would say about short-term rent prices, right? We need rents to remain strong to make sure, just as you said, Pablo, that this is an asset that pays for itself every single month. And that's why it's important to look at data like this. And at the end of the day, this is why one of the reasons we love investing in a critical need like housing. It's because demand largely doesn't waver, right? Unless you can figure out how to live without a house over your head and figure out another way to live there without buying it or renting it, like you are hedging your bets when you own this investment because it pays you 5 ways, and because over time, rents and housing prices have largely been consistent with inflation. If there's one out of the two of those that is even slower and steadier, though, it's rents, even comparing that to home prices.
Do you see? I think we're gonna put it down right there, man. I think this was a really, really good discussion. We didn't get to that third liquefied natural gas thing that we can hit on another time. That's not our area of expertise, but there is this idea of Jacksonville investing in the future of energy resiliency here in the U.S. Great feedback from the community today. Just really, really appreciate the dialogue. Really unbelievable questions. I'll be honest with you, right? We come into these always a little bit nervous because this is new to us, right? Like this idea of really giving you the platform to ask more questions and see if this will fill up a whole show and how much value that we can provide doing this. You keep giving us the positive feedback that it is great. And we see it by the fact that we started with 25 attendees and we're ending the call an hour later with 40 attendees. That means people are opting more and more in. We see it by like, thank you, Denny, for saying this, right? This idea that you're putting in that Denny writes, I listened to the two of these guys talk through this, and I wonder why doesn't this show have thousands of listeners? This is pure meat and potatoes, so much better than any other investment podcast out there. Man, that means so much, right? Like, and we ask ourselves the same question every day, right? Like we want to help as much as possible. So if you think that this is valuable, share it with a friend or send somebody the link to show up. But like sharing the podcast is the easiest kind of like low friction thing, but just really, really appreciate that feedback. GC, I know that you were going to say something there.
I just wanted to say thank you to Denny. Denny and I have been friends and with his family and Erica, his wife, and they've meant so much to our business. And to know that Denny is here supporting the show, it means a lot. And to just say those things, I just want to let you know it means a lot. So thank you.
Awesome. And like we teased, right? Next week, we are having the investor only call on Monday. And then we show up on Tuesday and we talk about the insider things that we talked about in the investor show call. Part of the perks of being part of the community. You don't have to be an investor to get some of the perks. You're not going to get the ROI without investing, but we're going to talk about this recession myth, right? Like this idea that people believe housing goes down during a recession. That's just not real. It's a myth. And it's only happened once in 100 years. And it happened because of very specific circumstances. Plus you're going to get all the statistics on the Jacksonville market, what JWB is doing, where they're headed, right? All the secrets that we like to talk about, and hope to have you on. Really appreciate the community being a part of this. We never take it for granted that there's more people at the end of this call an hour later than the beginning of the call. It's a Tuesday, middle of the workday, not a small ask, and you still show up. You still add so much value. And if you're listening on the podcast, you're listening on YouTube, come be a part of this. It's special. Like it's the only way that I can say it. And I'll give you final words, GC.
Just love being back in the hot seat. I truly miss it. And, when we started this journey 2 years ago, I never thought that we would be doing a show twice a week on social media. And I never knew it could be a community as strong as this. And I never thought that if I took a week off, I would truly miss it. And I do. I really do. I just love what we get the opportunity to do. And it's because of all of you. It's because you're here every single time. And yeah, let's keep growing this community. If you can just take a minute and just, text a friend and say, hey, go to nyais.com. Come and join me on the show. I'm going to be there, right? We can chat together. We can be there in the audience. We want to keep growing this audience with more of you all and your friends and your network. So thank you guys. Fired up for the show on Thursday, and then to break down that recession myth with you guys next week.
All right. Just remember, when you're sending this show to a friend, do not send it to anyone trying to be average. See y'all on Thursday.